Good late morning, everybody. It is Dave Payerchin. I have some good friends with me. As always, RJ Pepino is in the house. And we have a special guest here today on the Wednesday live stream, Mr. Aaron Chapman. Aaron is, let me share my screen here real quick. He's first and foremost, he's a friend. Aaron is been in RJ and I's circle for many years, and he is in the finance business. So he's done. I just learned this about you. Can you guys see my screen, by the way?
Can't see it, brother.
Hang on. I just learned this from. Can you see it now?
Yes.
Yep. Cool.
I recognize that bitch.
Yeah, there he is, everybody. Aaron Chapman, Security National Mortgage Company. He is OG in the finance industry, started in 97, comes from a background in mining, heavy equipment operation, long-haul truck driving. He was a volunteer rescue on the volunteer rescue unit, him and his wife, retired from that. But as far as the finance goes, I didn't realize this. First off, he's in the top 1% in the finance industry of over 300,000 licensed loan originators. And he has closed in excess of 100 transactions a month. That's the thing I want to point. That's insane, everybody. That's a lot. It's a high volume loan operation is what Aaron is familiar with. He's been around the finance game, like that just said, since 97. He knows, he's got his finger on the pulse of exactly what's going on. So we're going to be getting into picking his brain a little bit, talking about interest rates coming down, where he sees rates going, where he sees property values going. But first and foremost, before we get started with Aaron, RJ, how are we feeling today, sir?
I'm excited about this because this is the hot topic right now. Everybody's talking about this. It was the stock market, previous day when it happened, probably when we talked, right? And so now we're seeing the rates go down. So everyone's kind of talking about this. So take some notes. We're going to show you how you can attack. We've got one of the best in the industry to educate you on why this is happening, what he's seen. He's been in the business for a long time and has seen a lot of cycles. So I'm happy to be here, fully I'm taking notes as well. So I am engaged and ready to see what we can do to take advantage of the opportunity. A lot of people are talking about that right now. So
I'll share this real quick just as a piggyback to one of our previous live streams where we were talking about the Japanese stock market. The Nikkei came crashing down and it affected the U.S. markets and whatnot. And really what that conversation pointed to is something that Aaron knows very well. Him and I by the campfire, this is the shit we talk about, is like central banks and like the whole macro scale. We're not going to be getting too much into that. It's kind of hard not to when we're together, but since that video, RJ, when the Nikkei came crashing down and it affected the U.S. markets, now the Central Bank of Japan, they came out just today or last night, and they said, okay, we're not going to raise rates anymore. This is what happens. The market has a hissy fit, and the central banks, they say, okay, no, we're not going to raise rates. Everything is derived by the central banks. When they make moves, the markets change, right? And since the market had a hissy fit, the Central Bank of Japan said, we're not going to raise rates. So now the Nikkei is rallying. The U.S. stock market's back to rallying. It's just all this. We live off free money. We live off printed money. Everything has to do with interest rates. They just threaten to raise interest rates and things come crashing down. It's just an absolute banana republic, insane world that we live in. But Aaron, what is going on, sir? Let's get into some finance.
What's up, fellas? Good to see you guys. Long time since we've been able to do the face-to-face thing. What used to be every quarter, hanging out in Texas. Things change when people change, right?
We're dads now. And by the way, Aaron is a father of 4.
Yeah.
He's a badass father, and he's a
grandfather of 2.
Grandfather of 2.
They live right next door, so I think even my grandkids might be close to your guys' kids' ages.
Yeah, it could be. So, good to see you as well, brother.
So, man, interesting times. I appreciate the commentary you guys are throwing out there, and of course the intro. I've had a very, very interesting career, getting to see a lot of things. So what what's amazing to me, let me just touch on this. You've got a lot of people out there playing the game right now, making comments about some of these crazy types of loans to look at. There's arms floating around out there as people pushing like a 10-year arm.
Define what that is. Define what that is for our audience.
That means the interest rate is fixed for 10 years and can adjust after that 10-year period. So
is that what you hear when somebody says like a 10-1 arm?
10-1 arm said be fixed for the 10 years, then can adjust annually once on the anniversary of the loan. Every year after that, it can adjust. And it's set on, I believe that one's set on a 20-year amortization. I could be wrong. So that means you have to make your payments as if you're paying it off in 20 years. So higher payments to pay it off faster than 30. And then you also have that fixed period. So you get a little bit lower interest rate, feels good. Once that 10-year hits, though, and you start to see that movement, we don't know where the market's going to be. What's funny about these, and I've seen some, I've actually seen some 100% financing, zero down investor loans with some weird companies out there floating around. Let me just tell you guys, first off, the people that say that, I've heard guys that put this out there say something to the effect that this is for the seasoned investor. Well, the sumbitch is talking about that. I did their first loans back in like 2014 and 15. They're not seasoned themselves. If you have not seen 2000, the year 2000 in your business, you're not seasoned. So too damn many cycles have happened since I got in the industry. I don't feel seasoned. I've been doing this since 1997. And the reason I say that I don't feel seasoned is because what we're coming into has never been seen before.
So
I don't care what a person tells you their experience is. We don't know what to do with 13 years of quantitative easing yet.
So let's decompress. Let's digress just a little bit. So what Aaron is saying is he's seeing loan products out there where they're kind of teasing the investor. They're saying, hey, we'll give you a low rate, for a fixed amount of time, but then this rate is subject to change. That's a adjustable rate mortgage, aka ARM. That's what he's saying. ARM is adjustable rate mortgages. And then he's seeing a lot of 100% financing. That means the investor is able to basically get this deal done and not have to bring any money to the table. And it sounds good for the investor, but Aaron's going to get into why these kind of loan products could be a little bit dangerous. And then what he also said is we've never been in this particular type of environment where he said 13 years of quantitative easing. What that means, everybody, is money printing and low interest rates. So, basically what Aaron is saying is we're in a time right now that is unprecedented because for the prior 13 years previously, we've never been in a place like we're in right now where money has been dirt cheap, basically free, and the Federal Reserve has been printing money like it's going out of style. That's why this is a very unique time in history. Go ahead, Aaron.
So more than free. And I appreciate you going into the depth of all that kind of stuff here. And so let me just tell you guys, it does sound sexy to be able to get in with a low rate for a locked period of time or to do zero down, something to that effect. Now, that's very isolated types of deals. I don't know how much is available. They might find a small institution to push it through. Just warning you, stay away from that stuff. In the cycles that I've seen, a lot of people got financially crippled when they followed those types of deals. So that was just kind of a little bit of warning. If people are talking to you about something that's really sounds different than what you're hearing out there, walk away from it. Just point yourself in a different direction because a lot of times it's people just got in the business in the last 5 to 10 years. So do I have the capability to share a screen? We're talking about interest rates here. We mentioned quantitative easing. Let's take you back to where quantitative easing started.
All right. Yeah, you should have a little arrow at the bottom there.
Yep, I got it. So you guys are familiar with the mortgage-backed security, correct?
Yeah, so that's where basically originators like loan officers, they write a bunch of loans and all these mortgages then are bundled up in one giant package of notes and then sold to Wall Street, which is basically like sold to people's retirement accounts.
Basically, what it is, people's retirement accounts or pension funds, things like that, they will buy into these pools of money and then they'll say, we're going to throw the money in there. And as it's stacking up, they know what the guidelines are. They're written to say you can use this money if you follow this, if you meet this specific criteria. We as a lender have to ensure you meet that criteria. Then what we will do is we'll fund it ourselves and then send it off, and then they will take the money from the pool. Now, depending upon how much money is in that pool, interest rates are derived by how much money is in the pool. So as the pool increases with funds, the rates go down, supply and demand, just like anything. When the pool shrinks with funds, then the rates go up. So that's going to be important to remember as to why interest rates had that drop over the last little bit. So I'm going to go ahead and share screen the current bond pool that we are following for the mortgage-backed securities. And tell me if you guys can see this chart.
It is pulling up.
There we go.
Yep, you got it.
This particular pool shows you all the way back to 2008. So right here, it goes all the way back to, let me see here if I can see that part of the screen. The very first movement we can see here is back to, looks like August of 2008, right here. So actually, June of 2008 is what we're seeing here. So this is important to see because this was before the crash of 2008 had really, really started to hit. Then when you get to November of 2008, which is represented by these lines here, these horizontal lines. This is November 25th, 2008, right here. That was the day that Ben Bernanke came out along with Hank Paulson. Hank Paulson was the Treasury Secretary. Ben Bernanke was the chairman of the Fed, said, we're going to start quantitative easing. They announced it on that day. So that day, what I did was people started asking me a couple of years ago, when are the rates going to go back down? When are they going to go back down? I'm like, well, we know what drove the rates down was all the quantitative easing, money coming in from the Federal Reserve, being printed by the U.S. Treasury. Hank Paulson oversaw that, handed it to Ben Bernanke. Ben Bernanke dumped money into these pools because we weren't getting it from pension funds. We weren't getting it from other places. There was a stifle on that. So they announced it here. Well, on that date of announcement, we had a massive jump, and it continued to climb until the date that the Fed started investing money into it, which was January 2nd of 2009. So the reason that's important to remember is because then we get to see all of this. That when you see what had happened there, all that money coming in, this is the flow of all the capital from the Federal Reserve during this whole window of time up until October 13th, I believe it was 13th or 12th of 2021 when they started quantitative tightening. All of this above that yellow line represents quantitative easing, $8.9 trillion flowing into these pools. So normally you'd have pension funds, mutual funds, retirement accounts, putting money in there at whatever speed, which was below this yellow line, till enormous amounts of capital came in, printed capital, which increased the supply. Supply increases, rates go down. So we saw that till they stopped putting the supply in. They actually tried it way back here in 2017, right after Trump got in. They started that. That we had the same type of had what they called a taper tantrum. They put them in. Then they had COVID, which had another few trillion went in, and we had the lowest interest rates in history after COVID. So then they started the quantitative tightening, and that's where we start seeing this. And this is what I find people need to understand is where it fell off a cliff right here. Quantitative tightening, everything fell off a cliff. And then we went through that line that was established, which is the value of the security before the Fed announced quantitative easing was represented by this yellow line, which is the price of 100.54. We broke through that. Enough news came in. We hit a floor of support. Enough news came in to give value to the security, come back in, play with it a little bit more, pushed it right back down. This is when we had the current administration claiming that great jobs. The economy is awesome. So money's leaving bonds and going to stocks. The economy is supposedly great. Jobs are supposedly great. Well, that's actually people returning to work from freaking COVID, right? So we were getting fed a little bit of wrong data. Once true data started to come out from the BLS report, Bureau of Labor Statistics, it rocketed up. Money flowed into the mortgage-backed securities because, one, it was oversold, a lot more valuable than what it was at that time. Money just flowed into it in October. And then we get to January. Where did it stop? It stopped on that same yellow line that I was referencing. I'll zoom in on this a little bit more. Stopped on that line, started trading down, tried to ram again, hit that as another ceiling, hit it as another ceiling. Meaning that line that I drawn way back in here, I drew this out, showed that was the value of the security. That's how much money the market was willing to put into mortgage-backed securities. They didn't believe that there's more value in it than this particular price point. So it continued to play in this points. And then we had what happened this last week, which was the crash over in Asia, Japan. Then you had our stock market affected. Well, if money's coming out of the stock market, the reason it's crashing is people are selling off, right? Getting out. Where does it go? It flowed right to bonds, which is what they call a flight to safety is what they call it, because a bond is a long-term instrument that has a flat rate of return. This particular bond has a return of 5.5%. So they're going to dump their money in there knowing they're going to get at least a 5.5% while they're waiting to decide where they put their capital. It flooded in there, and look, it hit that line and pushed above it. This was Friday. I'm going to zoom in on this more. This was Friday this last week. This is the day everything freaked out. Everybody's like, wow, the rates are going down, rammed up. And then what happened the very next day? It opened up and slammed right back down close to that line. And then yesterday, it blasted below the line. And this is today. We're bouncing off the bottom of it.
So we're running into resistance. So we have to see if it confirms, right? That's the daily chart.
Yeah, because we're going to see if it confirms if this is going to hold. I've been claiming this for a long time. See, we've been hitting it, pulling off, hitting it, pulling off, hitting it, pulling off. There's a pattern here.
Correct.
We're following a pattern. We just pushed above it because we had an enormous amount of capital flood. All this was not; these were not stock market blips, crashes, whatever you want to call them. During these times here, this was testing the ceiling with prudent capital. This was freak out capital here that came in here because it had to go somewhere. It came right back out.
I think it's going back in. The market's charging today because, as we kind of mentioned, the Bank of Japan came out to ease the markets because the markets were crashing in Japan. And now they're like, hey, okay, we're not going to raise rates anymore. Calm everybody down. And now we're seeing, the NASDAQ's up over 1.5% today. So, flowing back into stocks.
Look at here at the Dow. Look at it. I mean, we were at our peak of 41,000. We approached 41,000 at our peak. And look at right here. We're knocking on 40,000 again. We went right back up. So we're back. We're back in the saddle. We're back swinging. So for me, a lot of people are of the beliefs like, okay, rates are going down. We're going to see everything get better. We're going to start charging towards 5%. I can't confirm that it's going to do that. I'm looking at the price action. That's what I like to look at is price action of the charts where they flow. Everything that happened here all happened to be just an anomaly with respect to the stock market. Now, there is a lot more talk about stock market getting heavily affected again. We can see even deeper crash.
There's a lot of downside to the stock market. It's way overbought, without a doubt.
Ridiculously overbought. Yeah. And the reation it's overbought like that is because of inflation. I mean, we have the highest influx, or at least the amount of how do I want to say it? The highest amount of currency in circulation right now that we've ever had in history. 40% or 50% of the current currency that's in circulation has been printed over the last 3 years. So that's insane. And I could be off on my dates there. I know there was like an 18-month window that 40% of it was printed. But when you have that type of influx of capital, it's got to go somewhere. So it's pushing these prices up. Now, I love to comment on inflation to folks to understand what really inflation is and how that affects them as a real estate investor. And that one of the reasons also is why I comment on those other types of loans I just referenced, 20-year amortizations, 10-year fixes, those kind of things, to be a complete insane proposition, regardless of what the rate is, because of what the dollar is doing with inflation. Now, let's go backwards 30 years. I walked into my very first Taco Bell in 1994 in Moses Lake, Washington. I looked at their value menu. They had 2 bean burritos and 2 crunchy tacos and a drink for $1.99. What does that cost today?
$4.
No, more than that. I'm saying $12.
It's $15.
Jesus, dude.
Exactly, $15. Burrito construction has not become that much more expensive. It's because what the instrument we're exchanging for the burritos and tacos is worth that much less. Another thing, 1920s and before, they made it a $20 gold piece. I forgot to get it out. I was going to have it to show you guys. 1 ounce gold piece printed for $20. You could buy a hat, a suit, a tie, a shirt, a belt, a pair of socks, and a pair of shoes for that $20. Right now, I can't even buy the socks I'm wearing for that $20, but I can buy everything I talked about with an ounce of gold. The gold has not become more valuable. Those clothes have not become more expensive. What we exchange for it has lost that much value. So why is that important for the real estate investor to understand? When you lock in a loan for 30 years, does the lender get to raise the payment on the loan because of inflation like we get to raise rents?
No.
No. They have to pay accept the exact same dollar amount for 30 freaking years. Well, when you recalculate the dollar as it leaves your hands, you get to realize that you're not giving them back what you borrowed. Too often we've heard people in the past tell us, our grandparents, our parents, other people in the investment world, David Ramsey, right? Susie Orman, pay extra, get a shorter mortgage, pay it off in 15 years. I'm telling you, don't do that. Now, great. If you want to do that just for putting your head on the pillow to sleep at night, that's fine. When you're talking about your investment loans, get that damn 30-year fixed and ride that sucker out to the very end. Because when you recalculate the value of the dollar every single time you make a payment, you'll find that you're paying less and less and less. Much like the situation with the tacos, right? That's a 750% swing on what I paid when I was 19 years old versus what I bought my daughter when she was 17 years old in 29 years. So when you reapply that same math to a real estate investor, it's getting a 7.5% interest rate loan, which we're a little bit lower than that right now for investors on 30-year fixed. They're going to pay $402,000 on a $160,000 loan. But the dollars recalculated over that 30 years is $152,000. They're paying less than what they borrowed. I'm telling everybody, quit giving a crap about what the interest rates are doing. If you're sitting on the sidelines, let's look at this as a Super Bowl, right? Everybody at the Super Bowl has a chance to get on the highlight reel. They said everybody's got a chance. If you run on the field at the right time, we'll put you on the highlight reel. So the whole stadium's got an opportunity, right? The guys sitting on the sidelines, the guys actually playing on the field, and the people up in the stands have an opportunity. But everybody's waiting for the specific moment. But one who is guaranteed to be on the damn highlight reel? The sumbitches playing the game. Those guys are going to be on the highlight reel. Too often we have people, and possibly people on this call right now, sitting in the stands waiting for the rates to go down. But when they do, you're going to run to the field, and you're going to get trampled and crushed. Yeah, I think it was Barbara Corcoran was recently on I can't remember what she was on. She was in an interview recently talking about interest rates. She said if they go down 1%, the price of housing will go up 10 plus.
Correct. This is what we've been saying on this channel. It's correct. I agree wholeheartedly.
We have experience to know that, right? When interest rates were at their lowest, back when they were at their lowest after the pandemic,
reverse market crash.
It was easy for for a realtor to say, hey, if you're going to make an offer, be ready to come in 50,000 over list just to get considered and then close with 100,000 over list. I don't give a damn if you got a 2.5% interest rate. You prepaid for it when you bought the house. Nobody won with that except for the people selling the house.
Correct.
So that's where we're sitting right now. You want to know what the effective interest rates are going down are, and people sitting on the sidelines waiting for that? Is you're going to get screwed and pay more for the house.
Correct. And guess what? RJ and I are, if you want to know, sneak peeking, we're selling. Median house price is at an all-time high. We're pruning the portfolio. So we have over 300 homes. We're taking a good hard look at a lot of homes. And it's like, what can we prune? We're selling at max retail. We're selling to retail buyers. And where could we effectively use that capital to acquire better cash flow positions and just better, we're making moves, right? But I think
real quick, Dave, we wouldn't be able to make moves if we didn't buy back then.
Correct. Exactly.
100%. If you guys bought last week, or if you bought waiting for the rates to go down and say, okay, we got all this money ready to buy, and the rates go down, you wouldn't have this opportunity. You were on the field playing this whole time.
You guys know the Chinese.
Your ass is going to be on the highlight reel.
I don't think it's a Chinese proverb. I think it's an American proverb. But they say best time to plant a tree was 20 years ago. The second best time is today.
It's today.
Right. You got to get in the game. I see this online, Chapman. I see these people. I'm not mentioning any names. Facebook is a joke to me. It's like everybody's just sharing their opinions. I don't care about opinions. And it frustrates. It's just so ridiculous to me when I see these people. They're like, all right, now I'm ready to go. You're ready to go now? What have you been doing for the last 5 years and 5 months? You got to get started now. It's not like, oh, I'm waiting for something to happen for me to get started. I'm waiting for conditions to be perfect to start taking action. RJ and I are deep in the game every single day, regardless of what's going on. It's just making these pivots and whatnot. So with that being said, what do you suggest? Somebody who's just getting started in real estate today, what is the play? What is your coaching to somebody just getting in the game right now?
Well, there's a saying that definitely accompanies this very well. My buddy Joel says it all the time. It's the start that stops most people. So if you want to get in the game, get in the damn game. Step on the field. That's it. Just cross over the line and step on the field. There is space for you on the field. And if you're not knowing where to go first, which direction you go, what direction we play in the game, where's the line of scrimmage, just call me. Get on the email me. Dave, I'm just going to give people my phone number, 602-291-3357, 602-291-3357. Just text me. Say, I listened to you on the live stream with Dave and RJ, and then my assistant Bree will set up a time for us to chat. Because the bottom line here is you waiting, you sitting here, you're missing out on opportunities that are literally floating in front of you. Because you're waiting for the one thing that may or may not happen. And all that happens when that does occur is it's going to take all those opportunities and push the price up by 10%.
I know you got to run, but I am going to put your phone number. Let me just confirm it, 602-291-3357.
That's correct. And then my website, aaronbchapman.com or aaronchapman.com, or just search out for Aaron Chapman on Google. You'll find a bearded redneck sitting on a porch.
So it coincides with exactly what RJ and I are doing. We teach what we do. We're not like some old school guys who used to do this back in the day. No, we're in the game right now. And the best thing to do is find great deals. We find off-market properties. We find deals, from motivated sellers. This is what we teach people how to do. We buy these properties. We fix them up. Typically, it's with private money. And then we call Aaron. We refi these things. We put this 30-year money in place, but we bought right. You make your money when you buy, you get paid over time, or when you sell. We're talking about buying and holding and maximizing the benefits of a low interest fixed rate mortgage over time, and how inflation is your friend when you have this fixed rate interest in place. But you got to get started. You're not going to be able to maximize the benefits of holding assets with this fixed rate debt like Aaron's talking about, unless you get in the game. So I'm going to put your phone number in the chat.
Phone number, website. And one thing, guys, when we talk, ask me and I'll explain to you how it is, regardless of what your cash flow is. As long as you're breaking even or going higher than that, it could be $50 or $100 a month, how you are going to be able to get a 20+% return on your investment annually, averaged over the 30-year fixed mortgage, by putting 20% down. I will prove it to you with the numbers, and then your cash flow will continue to come as it grows. So just know that this type of situation is setting you up for enormous wealth if you just get in the damn game.
I got you on the screen here now, 602-291-3357. Give me that website one more time.
AaronBChapman.com.
AaronBChapman.com. So with that, Aaron, I know you got to run. You have another engagement. I appreciate you hopping on.
Thank you, guys.
We're here every Wednesday, everybody. We're always bringing on special guests. Aaron Chapman is the man when it comes to finance. He's going to teach you more than anybody, really, when it comes to loans, finance, the Fed. And this is what we do. We buy assets, ride it out for the long term. That's how you build real wealth. Aaron, thanks for being here, bro.
Thanks, guys. Good to see you. And I'll catch you on another one because we definitely have to talk more.
Oh, yeah, for sure.
Later.
See you soon, my man. So, RJ, my goodness, what did you take from all that?
Here's some things that were talked about that I want to make sure everybody got. So first and foremost was this term called quantitative easing, right? Quantitative easing. What that is just a monetary policy tool. I'm reading right off of my phone here, that the central banks use to stimulate the economic activity to meet inflation targets. And what happens is, lowering of the interest rates, increasing the money supply. What does that mean?
Print money.
And then boosting the stock market.
Yeah.
Right. So a lot of that stuff was going on pre-COVID, that whole bull run. Then he's mentioned something. Something was called, I've never heard of, which quantitative tightening, which is the opposite.
Yeah.
So in May 1st of 2024, the Fed said that they're going to start slowing the pace of the decline of its Treasury securities portfolio to $25 billion a month. Anyways, quantitative tightening is the opposite of that. So let me just, it's a policy. It's basically in place to reduce the Federal Reserve System balance sheet. It's so crazy how they just, they'll have these policies. You don't know them. Like I don't follow it as much as some other people. But now I know where to go because we can just talk to Aaron, right?
Yeah.
And ask him, hey, what do you think of all this? And
That.
it's good to have. It's like this is the area that you can this community to stay ahead of this. If you guys are watching this live, definitely check out his website. Aaron's been in the game, not just recently, and not just when things got good for everybody. So be careful who you listen to. Quite frankly, I got into the game when the most recent real estate crash. Before that, Dave was in the game with the most recent real estate boom, 2005.
I didn't know what I was doing though, and I ended up losing it all because I
Right.
didn't understand any finance, adjustable rate mortgages. I had no clue about anything. I was literally trying to look as cool as I possibly can by borrowing tons of money and buying things that I never should have been buying.
Yeah. So what I'm trying to say is, guys, we've seen a lot, probably more than most, and we want to get into some Q&A based on what you heard. If you're staying on this live now, here's some questions that came up. Dave, you can have a take on this.
Yep.
If Harris wins, all right, we're gonna get into some of this. How bad are things gonna get?
Well, here's the thing, and I am like what they call a Fed watcher. I've said this on previous videos, said this on previous live streams. I read a book and it completely changed my life. And it's basically the scariest book you're ever going to read. If you're into horror books, if you're into scary things, check out the book, The Creature from Jekyll Island. And it's completely the playbook on how the Federal Reserve was created, how they run the show. So, yes, if Harris gets elected, how bad it's going to be? Probably not any better or worse than if Trump gets elected, to be completely upfront. And I know a lot of people don't want to hear that and they want us to pick a side and they don't. I'm here to let you guys know it matters way less who the president is. It's all Fed policy. It is all global banking that runs the show. And I'm not into conspiracies or anything like that, but I'm just here to let you guys know the Fed in the banking is far more powerful than any politician. So
here's my take on it, and Dave, you would agree to this, is you got to focus on what you can control.
totally.
Right? What can you do is you can create your own economy and play within the rules, be on the other side of the money printing. That's why we love Section 8. We're on that government side. We just had a mastermind the other day talking about this.
Yeah.
Is anything government related, because they're just printing money, as you can see, quantitative easing, they print all that money. They're tightening up a little bit, but they're still printing money.
They're never going to stop.
Get on the other side. Get on the other side of that, right?
Receive it.
Create your own economy. Focus on what you can control. Put yourself in a position where you can add value. How can you do that? Help people with their house problems. Contact those people. Talk to them. They might have single-family homes. They might have a portfolio of homes. 100-unit storage. Like, there's always going to be somebody that bought something, that got into trouble, or inherited something. Stay on that side of things. Become a problem solver. Become a person that's always adding value. That's how you can create your own economy, because now in this community, we're going to show you how to use the systems of none of your own money to acquire assets, get in touch with Aaron Chapman, who then places that 30-year financing on your assets, and do it over again and over again. And how to build a team without spending way so much, all this overhead. That's where we come from.
Yeah.
Like, we scaled it super big, and a lot of people are talking about scaling a business, but they're not talking about what they're actually bringing home, not even like on the HUD, like net after you pay your employees and marketing and lights and taxes and private. So stay tuned for more of that, because we're going to be showing you what we actually made on certain deals and so on and so forth. But the other question is, Dave, ready for this?
Sure.
You believe that Trump is right into, so this is multiple comments from this guy, John. Do you believe that Trump is right into going to Bitcoin? Don't know what that is, actually. I don't even know. Is Trump buying Bitcoin?
We got to remember this.
Who knows?
Here's the thing. No, he's appeasing to the Bitcoin crowd, which I've been very critical of Bitcoin in my content. You can look back. But as far as the Bitcoin philosophy and what they stand for, that true libertarian, end the Fed, a peer-to-peer monetary system without a central bank. Am I for that? 1,000%.
Oh,
Of
yeah,
course, that's
for sure.
everything I stand for, right? Like, why would you not? Like, I just told you the scariest and most evil thing on the planet is the central bank. So am I for the philosophy of Bitcoin? Yes. Am I for people just randomly pumping it and kind of, I know a lot of people lost a lot of money in crypto, and it's become this fad. But as far as the overall philosophy of Bitcoin, I'm 1,000% on board for that. Am I personally investing into Bitcoin? No. But does it have a, does it have a amazing following and crowd? Oh yeah. I'm talking millions and millions of people feel the same way that I do, which is it is a good thing, right? It is a good thing. Power to the people is what we're about. We're all about decentralization, of course, right? See the flag in the back? That's what that flag stands for, right?
Yeah.
But with that being said, Trump is still a politician, everybody. We gotta let's keep it real. Is he bullish on Bitcoin because he wants to end the Fed? No. He's appeasing to voters, guys. He's in the middle of running for a president.
Yeah.
So he's going to put himself in as many groups as he possibly can. Do I believe he's some Bitcoin bull and he's going to, kill the dollar and now we're going to be on Bitcoin standard instead of a dollar standard? Not going to happen. So I believe it is Trump being a politician, rightfully so, because he's in the middle of a presidential race and he's appeasing to people. There's no way we're doing away with the dollar.
No, I don't agree either. But I want to make sure everybody, the most important thing to take away from this episode of the Wednesday live stream is this: you got to get into the game.
Yeah,
we are very fortunate that even with our little bit of knowledge that we had back then, which was, we still invest in a lot of mentors today, but even with that knowledge we had back then, which wasn't a lot, guys, we went and imperfectly took action to buy these assets in the hood, which is when Dave's talking, we're pruning rentals. We're pruning a lot of our C-type, even like B- type properties, because there's always going to be, we've seen, there's always going to be another deal. There's always going to be units. There's always going to be someone in financial trouble. And we feel like we can get into some better asset classes. Yeah. We're looking at commercial assets. We're looking at bigger deals to take down and be on that side of it. We started back when we, our story, you've been following us as a unit, 2012, buying these properties and now seeing the upside of all that equity, right? And so if you're on the sidelines because of, and most likely it's probably it's a mindset thing, reach out to us. We can help you. A lot of the things that we talk about in our community is fixing your programming, which is your mindset that you've adopted, because we all run into it. There's still programming that I still have that I got to fix. I'm at it every day. Same with Dave. We'll help you get there because the tools and the strategies, you can get anywhere. You really can. Like, we're not the only people preaching about the BRRRR and, private money. But what we do have is the experience to relate to you and share with you some of the lessons that we have, and so that you can do a lot better than we did.
But you're never able to learn from your mistakes if you don't. What is the premise? What is the that's right. What is the underlying tone and message? We could bring on experts every Wednesday, which we do actually quite a bit. There's been amazing guests actually. The channel's growing. So let me just kind of give a shout out to everybody. We appreciate you being here. It gives us the encouragement and excitement to keep this thing going. We got lots of good content on board. I'm prepping for a video right now, everybody. And you know what? I'll give you a sneak peek. Office buildings are crashing right now. Did you guys realize this? Office building real estate, because post-COVID, everybody's working from home. And you know where an opportunity is, and I'm sure there'll be some big Wall Street money thrown at this, creating funds of buying up office buildings and creating residential affordable housing. I think that will be a play we'll see over the next 10 years. We're going to talk about that a little bit. That stuff's crashing, but we appreciate you all being here. Thank you for your comments. If you're interested in being coached by us, we sink our teeth in with our community, with our students. We take our coaching relationships very seriously. You can hop on a call with us. It is at creamlaunch.com, and we'll be on the phone with you three times a week, right? So our students are very successful. We'd love the opportunity to work with you and help you either get in the game or expand your game. So plenty more content coming this week, everybody. Lots of good stuff. We appreciate you all, and we will see you all on the next video.